Hello, investors. We are clearly in an interesting phase of market. We will have a discussion around three or four aspects: how the global economy is shaping up, and clearly it is far more complex and challenged from where we have seen it during last 2 years. Uh, the domestic piece, second, the domestic piece, which remains fairly constructive, while it will eventually can or possibly have an impact of external macro, but as of now it remains very, very constructive. Then the third piece we will kind of discuss would be the earnings and how earnings are shaping up. Earnings have been fairly resilient till now, except some of the externally focused sectors. And the last will be the view on market, how just as a summarization of the first three factors. Let us start with the first factor. When we talk about the global macros, they have remained volatile and complex for some time. When you look at some of the factors over last 2.5 years, first we clearly had a reflation, and now we are having the compression of the same policies. Logically, as the growth recedes, as the interest rates go up, the inflation should have receded by now. But unfortunately, we are in an environment where in a way, in hindsight, excess demand was created, aggregate demand was created, which now through interest rate increases, central bankers are trying to curb. But at the same time, the supply chains are challenged. So while the demand is gradually coming down, and it is visible particularly in Europe, China because of COVID is kind of under lockdown, so growth rates are slow. Even US is slowing down. So on demand side, clearly there is a slowdown. But unfortunately, given the geopolitics on the Ukraine-Russia side, because of which energy, fertilizer, and indirectly food prices, food inflation is remaining elevated. Similarly, China is under lockdown, so supply chains on China's side still remain challenged. So that's an environment in which we are operating. Logical sequencing of typical factors, what we observed between 2020 and 21 were that you got excesses of monetary and fiscal policies, which means you got liquidity. That liquidity translated into growth, whereby you saw superior growth to the averages in between despite COVID. And that growth led to inflation. Logically, the reverse sequence should have happened, that your liquidity comes down, your growth comes down, both of which is already happening. So liquidity reversal has been happening for almost a year now. The growth slowdown is happening for a few quarters at least, and it is likely to further slow down as the time passes on external front. The logical sequencing of the same thing would have been inflation coming down, which is still refusing to come down because of the complexities on the energy side, as well as the complexity of basically supply chains in China. So that's the environment on external side. What are the key takeaways for us sitting here in India? Two or three key takeaways for us. Clearly, the first is your underlying earnings growth channel, which is the exports channel, will keep slowing down. So if you have observed lately the data, the exports is slowing down. On a bottom-up basis, the export slowdown is visible in commodities, export-oriented sectors, partly even in IT, where the marginal earnings downgrades have been there. So that's the first factor, whereby the first channel, which is the exports channel, will play out in the earnings and has been playing out in the earnings. That's one. Second is, given this complexity and given the outperformance that India has seen, your flows will remain heterogeneous. While the flows might not be as negative as they were for almost last 1 year, whereby FI sold almost $30 billion of Indian equities, I think that will moderate clearly because you are towards the end of some of these events rather than at the start. But nonetheless, given the external uncertainty, your flows, FII flows will remain uncertain. That's second. And the third will play out basically in terms of macroeconomic stability or instability, depending on how the equation between energy prices, which have remained elevated still at $90 or $95, vis-a-vis how the import equation works out. Effectively, if imports remain resilient because domestic growth is strong and your energy prices remain elevated, which means that will show up in your CAD, whereby your CAD estimates have been increased over last effectively few quarters to 3.5% now, which is a situation where it puts pressure on the interest rates and currency invariably, and that's the worry that you should have. So those are the three factors. One, your exports are moderating, so earnings of some of the externally focused sectors will moderate. Second, the flows, FII flows will remain more heterogeneous than homogeneous. And third, your CAD at elevated level because of where the energy prices have stabilized can put a little bit of pressure on currency and interest rates both. So that's the context in which you are operating, which is the external context. Now coming to domestic macro, clearly both from macro and micro perspective, except the current account deficit, most of these indicators are still very, very healthy. So when you look at the tax collections, the e-way bill, the auto sales, the real estate sales, data points on the industrial manufacturing companies, order backlog side. So most of those micro parameters or some of the macro parameters remain extremely healthy. When we look at domestic context, out of the four parameters that we always discuss, exports is the only parameter which is slowing down. The rest of the three parameters, which is government capex, the household consumption, and the private capex stroke banking balance sheets, those three parameters still remain in pink of health. And let me spend probably a minute each on one of them. When you look at the government capex, it's still likely to do whatever is projected, simply because the tax collections are running ahead of the projections on estimated numbers. So despite the energy prices being at $90, your government capex is not under question mark, at least for financial year 23. When you come to the household consumption is a beneficiary of several trends. One is just the replacement demand in auto and real estate. Second, the top strata of the society have actually benefited through COVID because of where the real estate prices are, where their savings have come in, whereby basically their equity portfolio is still up, and there is a healthy wage inflation that is visible across the industry. So when you put together all those components, the household consumption on discretionary side as well as on the large ticket items like auto and real estate remains fairly good. So that's the second piece. And the third piece is basically the corporate capex stroke the banking balance sheets. Again, despite all the uncertainty through COVID on a 3-year CAGR basis, you have industrial companies reporting fairly healthy order intakes and order backlogs as far as the private side is concerned. And that when you particularly have a situation where the private balance sheets are delivered, when you have a banking system which is completely clean in terms of the amount of NPAs that it runs, most likely the outcome that you are likely to get in terms of direction and not necessarily the pace is that you are likely to get basically a credit growth cycle, which you are already witnessing. Credit growth has moved from about 6-7% last year same time to 15-16% now. Probably 15-16% might be a higher number, but it will settle somewhere at a healthy double-digit number. So credit growth has picked up. Your corporate capex is trending in the right direction. It might take time to take a shape of a larger trend simply because of the global uncertainties and uncertainties on the interest rates and its implications. But nonetheless, the trend is very clear, both on credit growth side as well as the private capex side. You are trending in a cycle where you are likely to witness a business cycle, you are likely to witness a credit growth cycle, and you are likely to witness corporate capex. The shape and form of corporate capex, of course, is far more nuanced as compared to the past cycles. So those are the four parameters. So when you actually summarize them, out of four parameters, which is government capex, private capex, stroke banking system, the household consumption, and the exports. Exports is the piece where you have more worries. Rest of the three pieces continue to kind of do a modest job or a healthy job in terms of the growth rates. So that's the domestic macro stroke micro. I think still has not seen any significant impact of the increase in the cost of capital, which has gone up by probably 200 basis points globally, and even domestically 250 basis points globally and domestically. We might see some secondary and tertiary impact of the increase in the cost of capital if this situation persists for a longer period. So that's the domestic macro. Now, how it is translating into earnings? Clearly, as we have been alluded in the past also, the earnings growth largely has moved towards the domestic cyclical from the global cyclical, and it also fits into our both top-down and bottom-up experience. So when you look at top-down, clearly the external piece is the one which is deteriorating more or moderating more than the domestic piece. That's where the earnings are decelerating at the margin or have decelerated in some of these segments. Whereas when you come to the domestic piece, the domestic cyclicals are the one which are experiencing either P&L correction, balance sheet correction, or just sheer underlying replacement cycles. So across the board, be it financials, consumer discretionary, the two pieces of consumer discretionary, auto and retail, the industrials piece, which we discussed earlier, and the two domestic defensives in a way, which is telecom and the domestic pharma companies. All these spaces is where the earnings upgrade cycle is playing out. Our sense is domestic cyclicals is a place where the earnings upgrade cycle is likely to continue for next at least 1 or 2 years, whereas the externally focused sectors, some of them while are fully corrected, some of them have not fully corrected, but that's where the earnings moderation is in place. So largely the earnings upgrade cycle is playing out, as I said, in financials, consumer discretionary, industrials. These are the places. Coming to how the actual numbers on earnings have played out, and just for simplicity taking Nifty, the Nifty earnings after initial 4-5 quarters of upgrades through June 20 to September 21, in last 2 quarters, broadly the earnings have stabilized or have taken a pause in terms of upgrade cycle, and largely that pause in the earnings upgrade cycle has come from the externally focused sectors, which is commodities, energy and IT, which are directly indirectly get impacted more because of the external environment than the domestic piece, and that's what has actually led to a marginal downgrade of 2 to 3% in the Nifty earnings growth. So as of now, the consensus earnings upgrade for Nifty are about 12% and 14% for financial year 23 and 24 respectively. That's where the earnings are. So coming to the last piece, how the valuations are. Valuations clearly are neither cheap nor expensive, for a very simple reason that you still have on a relative basis very high superior earnings growth to the rest of the world, whereas when I compared it with last 5 years, the price to earnings on a forward basis for India is about 19 times, which is where it was largely. But the other parameter, when you look at it as an opportunity cost, given that the G-Sec yield has moved up, so from that perspective, the gap between the 10-year G-Sec yield, which is the easiest option for an investor, vis-a-vis the equity market, has moved to about 200-220 basis point, and which tells you that from near-term perspective, you're more likely to experience the consolidation part of market rather than immediate uptick, unless and until you get basically the external environment clearing, getting better. So how we are looking at it, that as long as that yield sustains above 150 basis point, you're more likely to experience consolidation in near term. Whereas when you look at the medium term, all the structural data points or structural factors, and particularly I want to again repeat the quality of balance sheets and the leverage that the corporates are sitting on, which is an indication of the capex cycle directionally, given where the banking balance sheets are, given where the basically the households are in terms of their leverage, at least the top 20-30 crore people of this country who are large part of the BSE 500 consumption basket. All of those from structural perspective remain very constructive. So near term, clearly based on the valuation, it looks like based on the valuation plus that the earnings have taken a pause in terms of upgrade cycle, there is likely to be a consolidation. But when you take a 2-3 year view, clearly you have a domestic business cycle, credit growth cycle, and capex cycle most likely to play out. That's where we want the investors to focus on that larger picture, where structurally lot of pieces or enabling factors in terms of corporate banks balance sheet, corporate balance sheets, bank balance sheets, the top 20-30 crore people household balance sheets, all of those things have come at a stage which indicates that directionally you are in a business cycle. That's what for from our side for the time being. Thank you. Happy investing.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.